In market news now, global stocks moved up as a U.S. holiday made for slow trading ahead of minutes from the latest Federal Reserve meeting and a reading on core inflation that could add to the risk of interest rates heading higher for longer. The dollar, which is heading for its largest one-month rise since September in February, was roughly flat on the day, giving some lift to commodity-linked currencies thanks to a rise in the price of raw materials such as crude oil and copper. Locally, Anglo-American Platinum, the world's biggest platinum miner by value, cut its dividend payout as worsening South African power outages continue to curb production and crimp profit. However, to talk to us about the latest when it comes to the markets and, of course, through to what we can expect for the week, we are joined by Gary Boyson from Rand Swiss. Gary, thank you so much for your time. Let's get in terms of market sentiment right now. What's driving markets?
No, I think you're right. There's definitely a sense that there's low volume coming through the market today with the US being closed. I think a lot of people sitting on the sidelines, a couple of big events coming out this week, which I think everyone is probably treading water ahead of. So we've got the all-share index up marginally, a little bit of optimism around there, but you can see the financial index is flat. The resource index is essentially also flat, and it's only the resources, at least the industrial index is also flat, and it's only the resources that have managed to add just under 1%, which has lifted the overall index. So S&P 500 finished down last week, finished down 0.28%. We're seeing a little bit of a recovery in the currency after that big weakening. So we've got the currency back at around 18.10 currently against the US dollar. So that's also a little bit of optimism creeping in. But with the US out of the market, it's anyone's guess what's going to happen tomorrow. And as I said, a lot of big news events coming up today.
Given some of the bumper figures we've received, whether it's the jobs report or the inflation data, does the possibility of a 50 basis point hike, does that hurt the market right now if we start talking about it? Because the data we've received kind of suggests that, it's ripe for a 50 basis point hike.
Oh, absolutely. It's definitely back on the agenda. So if you look at something like the federal funds futures, which is essentially bets on what you think is going to happen on the currency and people putting their money where their mouth is, there's currently around 81% chance that we're going to have a 25 basis point hike, so 0.25%, leaving about an 18.1 to be exact, chance of a 50 basis point hike. So largely the market is pricing in, based on Fed funds futures, that we're going to get a 25 basis point increase. But that 18% chance that we get a 50 basis point increase has been steadily increasing, as you mentioned, as that bumper jobs report came out, as we were expecting unemployment to go to 3.6% in the US, and it actually went to, it actually strengthened to 3.4% unemployment rate. So a lot of surprises in the numbers, and that 50 basis point hike still moving onto the table. Now, if we get it, I think it's on the 22nd of March, it's, that's a big surprise to markets because the probability is for the 25 basis point hike. So what will happen is we're going to see the US dollar absolutely fly, as the expectation is that the Fed is going to have to keep things tighter for longer, that we're going to have higher interest rates for longer, that you can suddenly get a yield on US dollars. That means negative for equity markets. This means commodity prices will probably collapse. So it will be a shock to the market, but it's something that is starting to be priced in, and it's on the back of this very, very robust data that we've been seeing.
Locally, as I mentioned in my intro, Amplat's releasing their results, but also saying that the uptick in load shedding is going to be jeopardizing their PGM output guidance by at least 5%. What do you make of those figures?
Well, the market certainly doesn't like them. So the stock's down 3.2% at the moment, and that's into a rising resource index. So the market definitely a little bit disappointed with that. Now, it has been, I suppose, a theme across many of the trading updates and production updates that we've seen from specifically the locally based miners. And this, yes, part of it is load shedding. I mean, we've seen a big increase in their cost base as well. It's not just load shedding and electricity costs. We've seen increases in labor costs, costs across the board. Inflation is definitely making it more expensive for Amplats to do business. At the same time, there has been some, I suppose, delays, supply chain issues. There's been some operational issues for them as well. So specifically at their, at the rebuild of the Polokwane smelter, that's been delayed. They have the CEO that's been announced that is stepping down, Natasha Viljoen, and their guidance at the moment, 3.6 to 4 million PGM ounces for 2023. That is a little bit disappointing to markets. Of course, the dividend did come down. I mean, the dividend is down 60%, but that's off a bumper year. We had a great year for commodities, previously, the year before. So this is coming off a high base as well. So it's, maybe the market a little bit disappointed in the lower dividend, but they really should have been expecting that given just how strong the results were the year before.
With just a couple of minutes left to the interview, I know the Financial Action Task Force will decide on whether to grey list South Africa this week. What are your clients asking when it comes to that issue?
Well, it's not really from a client point of view. So clients seem to be largely unaware or not really concerned about this. We're seeing it more from, interestingly, from the compliance side. So the clients, I think they think that this is largely priced into markets. I don't think we're going to see a big reaction in financial markets pricing, if we are grey listed. But what it is going to do is it's going to increase the compliance burden for financial services providers and banks dramatically. And what that means for consumers, they're going to feel that a little bit further down the line in the fact that if you want to open an offshore account, if you want to do anything complex, the requirements for opening an account are going to be a lot more complex because the response by the regulator to this grey listing has really just been to write a lot more laws and engaging with compliance. I mean, our compliance team has tripled, in the face of grey listing, purely because of the grey listing. And I can tell you, most financial services providers and banks are feeling the same kind of pressure. Now, chatting to compliance officers at the moment, I've spoken to many over the last month or so. They're almost in tears. They're saying there are now so many regulations that are being put through by our regulators in response to the grey listing. They're not actually sure how they're going to be able to implement it. So it's an issue, and you're going to see it, I think, in the cost of your financial services, and you're going to see it in the administrative difficulties that you face when opening new accounts.
All right, Gary, let's leave it there. Thank you so much for your time. That is Gary Boysons from Rand Swiss giving us his perspective on the markets, but also letting us in on what we can expect should South Africa be grey listed. But I also mentioned those FOMC minutes, which we'll unpack for you later this week. But that is it from me. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.